Thanks for joining us today on Market Call. I'm Morella Fernandez. Ryan Bushell on the show, President and Portfolio Manager, Newhaven Asset Management. He'll take your questions today on Canadian Dividend Stocks. Here's how to reach us. Call us toll free at 1-855-326-6266. You can email your questions as well, marketcall@bnnbloomberg.ca. Good to see you.
Thanks for having me.
Big drops in the North American markets today. It feels like there's been a churn of volatility just at the end of the year. Typically, it's not really like that. What do you think is driving the volatility now?
Yeah, well, if I knew, I would maybe be somewhere different. But I wrote in my notes on the earlier this week. The Fed's out of the way. 2 weeks left before the end of the year. We should be coasting in. Doesn't appear to be the case. It could be a chance. That there's been some mixed results out of Oracle and Broadcom, and I think anything. The sensitivity around AI and especially AI capex right now is hypersensitized. Combined with that potentially people were waiting for that last Fed catalyst, and okay, now there's nothing left. Maybe we trim positions into the end of the year. Who knows? It doesn't really matter to us. The interesting thing, though, if you watch the last couple of days, is the TSX remains strong. It's down today, but down much less than the Nasdaq and the S&P 500. And another thing I was talking with someone about yesterday was, looking back on this year, it's been such a crazy year. It feels like it's been 4 years.
It really does.
If you look back this time last year, we weren't even talking about tariffs really in a major way yet. Now it's a part of our everyday discourse. So when you think about that, and then you think about, okay, even if we had known that, how would we have thought the markets would have reacted? I don't think we would have expected TSX up 30 necessarily either. So it's been a surprisingly strong year, a good year for us and our clients, and that's why you stay invested. You don't know when things are going to perform. You don't know when things are not going to perform, so you have to sort of stay the course no matter what.
With the pushback on AI, do you feel like investors are throwing the baby out with the bathwater?
I have concerns. I have legitimate concerns. Most of it stems from the fact that this looks and rhymes with a lot of things that have happened previously. So I'm sort of a student of history and someone who uses the past to inform, the decisions I make about the future. And the other thing I think that is concerning is just how big the influence is on the broader market. So if we have a problem here, it is going to be systemic. And where we're seeing the concern, I think, is where it is really starting to initiate is around the bond market, actually, and the amount of borrowing they've done recently. The capex continues to inflect upwards from already elevated levels, which now must be financed with a combination of more debt than equity. And so I think that's kind of where the rubber is going to start meeting the road on. We're going to have to start seeing some cash flows and some profits out of this.
I know you are long-term investors. I'm just wondering if you're positioning a little differently to start 2026.
No, I mean, we haven't really changed positioning much in the last couple of years, actually. We were early into the theme of electrification and demand for electricity. AI has pushed that further than we would have thought. So there is some concern there that if the data center build out doesn't prove to be quite as broad as people are thinking, that some of the steam comes out of those stocks, but it's going to hurt the hyperscalers more so. And we're not counting necessarily on that demand. We're counting on steady demand from nearshoring and reshoring, climate change and migration, warmer temperatures, more air cooling demand, and data centers are kind of on top of that. So we're pretty happy with how we're positioned, and what we'd like to see actually is a broader mean reversion, meaning a pullback, to get some more money invested. We've got about 10% in cash across the board, and we'd like to be sort of more, especially with interest rates dropping to where they have been, more like 2 to 5.
Okay. Let's take a quick break. We will line up the first phone calls and email questions for Ryan Bushell of Newhaven Asset Management. Once again, he's taking your questions on Canadian dividend stocks. Here is the number and the email. We're back in just a moment. Stay tuned. Welcome back. We're going to start with an email from Hillary. She says, I've held on to Saputo for a while and am now above water with the stock. Do you think there's a strong future, or is it time to sell without a loss? Saputo's doing pretty well. They're up at 40.47, actually on a high today. Is this a stock you would hold on to?
Yeah, so we don't own Saputo, and I having received this question ahead of time, I looked at the chart and was surprised to see the dramatic move it's had since the beginning of the year. This is a stock that's been kind of depressed for quite some time. If you put up a longer, like a 10-year chart, you can see that. And so what's driving the move this year? Well, there has been definitely some improvements at the company. But what I would be concerned about in this sector is, one, you've got some government assistance in Canada that goes into the dairy sector, and how does that play out with USMCA being renegotiated? You've got other jurisdictions around the world, and trade is getting more and more difficult, especially in protected industries like dairy. So, if I was holding it, I would be taking a long look at, we've been through some pain on this. We just got a bunch of it back in 6 months. Maybe there's something better we could own. But I don't own it, so I don't have that same thought process. But I certainly am not looking at it as a buy here for our clients for new money.
That was for Hillary. Let's go on to our first phone call from Bob. He's in Toronto. Hi, Bob.
Yeah. Hi, Ryan. Ryan, I'm wondering if you can give me your thoughts on Brookfield Renewable. I'm about breaking even now, and I'm just wondering if I should get out of it now and take my money, or do you think it's going to go higher? Thanks for your comments.
Okay, we'll pull up Brookfield Renewable and have a look at the chart. Most people like the Brookfield brand.
Yeah.
I don't know if you have put money into renewable, or do you tend to look to other parts of the company?
So we do own renewables, and it's been nice to see it have a recovery this year. If you look at the deals they've signed with some big hyperscaler clients, Microsoft, Google, things look pretty good. And as well, they've got the nuclear side of the business with Westinghouse. We like that going forward as well. So you're still clipping about a 5% yield. One thing I would say is the spread between the renewable units and the corp shares is historically wide for both renewables and infrastructure. We'll talk about infrastructure later. And so for me, again, as a Canadian citizen, if you have an RSP or a TFSA and you're looking at buying either one of these companies, putting it in there is almost a layup. You're getting basically a third more yield for the exact same company, with the chance that, potentially they either change that structure or you get revalued up where the institutional buyers. Now, it has happened that the spread is actually usually closed on the downside, meaning that when things get worse, the corp shares just decline more than the unit shares, and then the spread narrows. But either way, we like that. We'd rather have the downside protection. We'd rather clip the extra income. So that would be a recommendation if you are looking to buy it or hold it. That would be the one I would be holding.
Okay, let's go on to Mike then. He's in Toronto with a question. Hi, Mike.
Hi, I'd like to ask about K-Bro Linen. I've held it for a long time as kind of a safe and steady stock. It's come back quite a bit. Do you like it here to hold and possibly add to?
Okay. K-Bro Linen, of course, does linen, I guess, cleaning, laundry, hotels, and healthcare?
Yeah, primarily healthcare, but some hospitality as well. And in the UK and in Canada are their jurisdictions. We have the exact same opinion of the company. So we like it on a long-term basis. It's a good diversifier. It is a steady business. It is something that we think we will wake up one day and just see the value realized. And in the meantime, we're happy to buy it. So whenever it dips below 35, that's kind of our level of where we've been adding. And when it's above there, we're holding. So we like stocks like this for clients that, we have clients that are going to be with us for decades. And so we like a company like this where we can put extra dividend flow back to work at a good level, knowing that we've got a good management team and a good underlying business that eventually will, just prosper alongside, the management's decision making and just the GDP growth of the countries in which they operate. So we like it quite a bit.
And it's a dividend of about 3.5%?
That's right. And we should see some dividend growth. They just did a big acquisition, so we're probably a couple of years away from seeing that dividend growth. But as the company grows and its financing commitments for tuck-in M&A get smaller relative to the size of the company, you should see that free cash flow hopefully going towards a growing dividend. We'd like to see that, and we talk to management about that regularly.
Okay. Let's go to Frank then from Toronto with a question. Hi, Frank.
Hi. This question is for Ryan. Thank you for taking my call. I was inquiring about the Rogers Communications. What's a good entry point, and where does he see the stock in 12 months? I know they have their sports entity, and I heard rumors about it being a spin-off in the coming years to come. And I just want his opinion on that. And thank you very much for taking my call.
Okay, thank you for the question. Roger's at 49.83. And what he's talking about is that they've accumulated a lot of sports teams under the banner, and that they might do something very specific with that, but we don't know what they plan to do.
Yeah, and it's interesting. So you've got a couple of layers here. So number one, the stock's traded up this year. So certainly the Blue Jays run didn't hurt, but I think it's mostly on the back of the negative performance in the telcos. So you've seen money rotate from the telecom companies to the cable companies, which is Rogers and Quebecor. I still think they have an inferior network in terms of both the wireless and the wired side. So where the CapEx is largely done or further advanced for the telecom companies, I think the cable companies now are faced with the prospect of upgrading their networks or just continuing to cash flow them. But I would rather have the superior network. And then you mentioned the sports assets. So that really is the big question right now. And that's why I think you've seen the company revalue higher, is that people are seeing the valuation for sports teams. You saw what the Celtics went for, or the piece of the Lakers went for over a $10 billion valuation. So you start to value the Raptors, the Leafs, and the Blue Jays, and then the rest of MLSE, Toronto FC, et cetera. And then you start to come up with potentially a pretty big number. Now, the question will be, number one, they have to buy out the minority stake that is still out there. So they've got more debt to take on to do that. And then the question is, do they IPO it? Do they sell some of it to private equity? I think the family wants to keep some, so that's where, and they probably maybe want to maintain control as well. So it might not be as big of a monetization as some people are thinking and hoping for, but it's definitely a good asset. So I think where the stock's valued today, I think it's pretty fairly valued. I think the telecoms are much cheaper, and probably we're due for some sort of mean reversion and reverse trade there. So I'd be cautious on Rogers, and especially more cautious on Quebecor. But if you own it, I don't see any reason to part with it either. That sports catalyst is just very uncertain, so we'll just have to see how that goes.
Yeah, we don't know the timing of that. All right, we're going to take a quick break. We are back with Ryan Bushell of Newhaven Asset Management. After that break, he's taking your questions on Canadian Dividend Stocks. Back in a moment. Welcome back. Let's go right to the phone lines. Joe's on the line. He's in Montreal with a question. Hi, Joe. Joe, are you there?
TD Bank. I'm a senior. I bought TD Bank over the last year and a half at around 78 average cost. But I noticed a lot of corporations are starting to unload TD, maybe because they reached their highs. Would this be a good time to take some of the gains off the table, or do you think it's in for a longer ride in the next, let's say, 3 to 4 years? I appreciate your advice. Thank you.
Thank you, Joe. A lot of people were looking to capitalize on the beatdown of the stock after the penalty in the U.S. It's up to 125.44, so it has done well. Would you trim a little bit here? Would you hold?
Honestly, it's surprised us quite a bit. I mean, we were patiently or holding our nose and buying it on the AML problems, in the 75 to 85 range, and the run from there has been incredible. All the Canadian banks have had a great run. I think you've seen money just broadly coming into Canada. If you look at the large cap space, the big oil companies, the big infrastructure companies, which we own as well, we've seen that across the board. One place it hasn't gotten to is telecom and railways, which is they've been sort of languishing. So I'm not too sure what's driving the move, especially if you look at that move from 90 to 125. So for clients that are in need of cash, we are trimming bank holdings at these levels. We are not purchasing. So I guess that's maybe your answer. But on a long-term basis, we're not selling like 50% of the position. This is 5-10% of the position if someone needs cash to cover a RSP payment or what have you, and any type of year-end expenses that they have. We like the banks on a long-term basis. It is an oligopoly. This is why you own them. They have pricing power. They have diversified business units that offset each other and work well. Capital markets has been a huge winner for all the banks this year. So again, but when I look ahead to 26 and 27, I don't see it getting a lot easier. So it's going to have to continue to be capital markets and cost cutting, and I don't see the lending environment getting a lot easier. Rates are back down. That's going to theoretically compress net interest margins potentially. So, I think it's a mixed picture. And so if you have a big weight now, I don't mind trimming some here.
Okay, let's move on then to Alex, who's calling today from Vancouver. Hi, Alex.
Hello. My question is on Dye & Durham, D&D. Would Ryan be buying this stock at this level? Thank you so much.
Okay, Dye & Durham in a very specific situation, of course, with investors pushing for certain things. They are down to $4.36. What's your take on the situation with Dye & Durham?
Yeah, so again, this is a good example of a company we just won't touch. And it doesn't mean that the company won't have prospects. It doesn't mean that it won't recover. You've got a lot of things happening here, kind of management turmoil, family issues, a lot of, you've got a fight with the board, there's legal proceedings happening. And so, we don't want that kind of noise. And even if it's a great opportunity, we want to see the dividend income. We want to see the consistent approach from management. Even if they have a misstep, we still think, steady management is what you need to get through a bad time. And actually, we're very happy for our companies we own to have a bad time so we can buy more. But this is not that situation. This is a company that has lost, 80% of its value, 90% there on a 5-year basis. We don't want that for our clients. And it's likely not ever going back to that level. Now, could it get back to 30? Probably, but that doesn't help the people that bought it at 45. So, it's just a good example where, everybody's got a different investment philosophy, and somebody might want to take that shorter term move and have a really strong view on what's going to happen with the legal proceedings and what's going to happen with management. We don't want to take those chances. We want businesses where we don't have to worry about that kind of stuff.
Okay, that was for Alex. Let's move on to Sylvan, who's in Montreal. What's your question today?
Good afternoon. I would like to know your outlook for TELUS and why the company does not cut its dividends. Thank you very much indeed.
Okay, thank you for the question. So the company did not cut the dividend, but said it's not going to raise its dividend, essentially. What did you make of that move and the sort of after or fallout on the stock?
Yeah, this is surprising to me as well, sort of similar to TD, but in the opposite direction. So obviously there's blood in the water. After BC cut its dividend, there's lots of reason for people to run away from its closest sort of peer. But TELUS is in a bit of a different situation. Their CapEx spend, the big decade-long fiber to the home CapEx spend that both companies embarked on, they started on it 2 or 3 years earlier, had an easier time of it because they're in jurisdictions with kind of newer infrastructure, so we're able to do it a little bit easier than BC's been able to do it in Toronto and Montreal. And so now with that CapEx build coming to an end, I don't think they have to cut the dividend. Now, if the market's not going to pay them for it and they would rather see them pay down debt faster and have that kind of response, then you may see management ultimately cave to that. So I'll give you 2 examples from the past. So, and both companies we own. So we owned AltaGas. They did a acquisition in the U.S. This is around 2017, 2018 of Washington Gas and Light. It was a utility in the D.C., Maryland, Virginia area. Rates rose a little bit. People were really concerned that they had overpaid for this asset and rates were rising and they weren't going to be able to finance it fast enough. And they took the stock from $30 down to $13 and they've basically forced a dividend cut. And the company had to sell assets. And now you look at the company today, I'm going to talk about it was a past pick, but it's $41. That asset they bought is a great asset. The blip in interest rates was not something to be worried about. This is a 100+ year asset that they're purchasing. So spreading out that purchase cost, even if they did pay $1 billion too much, you're spreading that out over a long amortization period. And it was just a complete overreaction. Enbridge, same thing. 2018, Enbridge, they're over financialized. They need to cut the dividend. They've got too much debt. And Enbridge basically did the same thing TELUS did, which they said, okay, they didn't actually slow the dividend growth to 0, but we're going to slow the dividend growth way down. We're going to grow back into our earnings level. We're going to clean up the financial side of it. And now you got Enbridge at $65. It was about 37 back then. So, and we clipped the dividend in both those companies. AltaGas is now raising their dividend back up all the way along. So I think this is short-termism by the market. I think TELUS is just fine. The dynamics of competition in Canada has been tough. but I don't think it's going to stay tough forever. And these are forever assets. That fiber optic network is not going anywhere. It's going to continue to be in use as we add people to this country and add businesses to this country. It will continue to be in use. So I wouldn't sweat the small stuff, and I'd be buying it here.
Okay. Just want to remind people, BCE is parent company of Bell Media, which is a parent company of this channel. Okay, let's go to Gary. He's got a question. He's in Edmonton today. Hi, Gary.
Good day. Yeah, my question's on Bank of Nova Scotia. I'm up pretty good on it. Pays a good dividend. Do you like it and do you own it? Thank you very much, sir.
Okay. Scotiabank's also in a transition, essentially.
Yeah, so we own it, and it's been in a transition for as long as I've been at Newhaven anyways, 7 or 8 years. It's slow going. They purchased the stake in KeyBank. It's the market didn't really love that, and doesn't look like they're purchasing more of that. So the question is, where are they going strategically? What is their next move? In the meantime, with all the banks, what you have is cost-cutting capital markets and share buybacks. And money broadly, I think, flowing into the Canadian market with TSX outperforming S&P this year. So I think that's really what's driving these companies. Fundamentally, I don't think actually that much has changed for Scotiabank. It's just been kind of a re-rating on the multiple, and that's similar for TD as well, by the way. So yeah, I think, again, if you're overweight, I don't mind trimming it here. I wouldn't be purchasing. I would be waiting for, again, I don't think there's any calamity that's going to happen to Scotiabank or the Canadian banks in general, but we just like to see some heat come out of the market before we started buying more.
All right. On that note, we're going to take a quick break. We will be back with a look at Ryan's past picks in just a moment. Stay tuned for that. Welcome back. Time for a look at Ryan's past picks from February 4th of this year. At the time, he chose Pembina Pipelines, PPL, on the TSX. It was 52.09 at that point, 53.95 today, so a return of 4%, a total return of 8%. Have you held on to Pembina? Is this a stock you still like?
Yeah, it's a stock we like a lot. It would be a top pick if it wasn't a past pick. So maybe I'll do 4 today. But if you look at that chart pattern, it had a big spike up on some data center news in October there, and then came right back off because KKR is potentially shopping their stake in their joint venture with Pembina. I think there's still concerns on the floating LNG project, which we don't have concerns on, actually. And if you look at that chart pattern, it looks like it's trying to bump through 55, and it just kind of keeps bouncing off that level. I think once it does, it looks pretty good. If you look at the way the other big infrastructure companies, primarily TC and Enbridge, have performed, this one's lagging, and we actually think the growth prospects ahead for Pembina are as good, if not better, on a per-share basis. So really like it. And in the meantime, you clip 5% while you wait.
Okay, Pembina Pipeline top pick there. Let's go to your next past pick, Freehold Royalties, excuse me, FRU on the TSX at $12.65 back in February, now to $15.22. And a return of 20%, total return of 27%. Do you remember the reasons behind picking it in February?
Well, I liked the 7% dividend yield, which I thought was sustainable, but I wouldn't have expected it to perform this well in an environment where crude's down 12 or 13% this year. So kind of surprising, even just as surprising to the banks. But again, you have seen money rotating from other places to Canada and from other energy areas to Canada. There's a wide range of reasons for that, which I think I discussed in an earlier appearance on the street. This is a company that is starting to get a nice re-rate. You're still collecting a hefty dividend yield. Again, right now, crude prices, I think they probably get worse before they get better, but ultimately I think the seeds are there for crude pricing to firm up, when we see either better economic activity or what the visibility is going to be geopolitically. We like it for on a long-term basis, and we're happy owners.
You don't worry about oversupply, which is a concern somehow?
Oh, sure, yeah. I mean, you worry about that all the time, but at the end of the day, oversupply then breeds the next range of undersupply when investment drops, and you're seeing rigs continue to drop in the U.S. It's not easy to make money down there either with that shorter cycle production with high decline rates. So you could see production come off there. Exxon's guiding to some pretty hefty production increase numbers, and there's production increases coming out of Canada as well. So I think we're in a sloppy oil market for the foreseeable future, but a Canadian dollar royalty company like Freehold can still make enough cash flow to pay that dividend, and we're happy if it just keeps churning out 7%.
Okay, let's get to your next path pick. AltaGas, ALA on the TSX, so natural gas play here at 33.89 at the time you recommended it in February, now to 41.58. So 23% upside, 23%, 25% total return. Natural gas prices are coming back. Is this a longer term hold for you as well?
Yeah, so this is one of our largest positions, and this stock was left for, as I mentioned earlier, left for dead twice in 2017, and then or 28, maybe it was 2019, and then again in 2020 during the pandemic. But again, this is where we do our homework ahead of time. We like the core assets of the business. We like the management team then. The new management team has been even better, and that's, you see the power of, when the assets are good, whatever the pain is temporary, and we've seen that. And so companies increasing its dividend 6% a year. I think this is the third or fourth straight year of that, and has a really bright future ahead with some LPG export project capacity coming on. Still a huge amount of accelerated replacement programs in their U.S. gas utilities, and really, a company that people thought was disparate parts just a few years ago. Now all the parts seem to be working together. So that's what a good management team does.
Okay, that was AltaGas. Let's take a quick break, line up some more phone calls and some emails for Ryan Bushell, Newhaven Asset Management. Again, he's taking your questions today on Canadian dividend stocks. Back in just a moment. Welcome back, and thanks for joining us. Let's go back to the phone lines. Reg is on the line. He's in Winnipeg with a question today for Ryan. Hi, Reg.
Oh, hi. Thanks for taking my call. Ryan, my call today is on Manulife Financial. Now, I phone in every once in a while to BNN. Manulife is really a head-scratcher for me. Based on, the world reopening post-pandemic, Manulife has some very unique products that, the world will need, on the insurance side. They come out, they beat analyst expectations about 3 weeks ago. The reward for that was basically the stock is flatlined. When you look at the fundamentals on Manulife, almost 4% dividend, their dividend payout, they use about 50% of the reserves, much less than the banks. You line Manulife up to the other insurance companies, Sun Life, Great-West Life, it trades much less on a share value price. It makes zero sense. The bank analysts drag their feet on re-rating Manulife. I have no idea why Manulife is only at $49 a share. Easily, this should be over $60. Can you kind of explain a little bit about why it just flatlines? Thank you.
Okay. Do you see any clear reason for it flatlining?
I think this is an interesting point the caller makes, and I think sometimes things happen in mysterious ways, and whatever captures the attention of the market, and especially the shorter term money that trades at the margin, like, you have to remember that price is set by the last buyer, right? So, and I'm not saying that the caller doesn't know this. It's just, I even have to tell myself, like, I have to remember that the last trade price, or the price I see on the screen, is just where two people just recently transacted. And it doesn't tell you much about the future of the company, and it doesn't really tell you much about anything other than, at this moment right now, this person was willing to exchange with that person for this price. And so I think with Manulife, what you're seeing is, number one, people have a long memory, and Manulife hurt people so bad, there's still people that won't come back to a stock like that. We do own it, and have owned it all the way up from $20, and have seen nice gains in this company, because we are a company that tends to be more patient with companies and tries to see the future when others are either mad or unwilling to. And so, we're happy with it where it is. I think also you're seeing that it has to digest that big move. Like, most of that move happened last year. You can see it on the chart there, right? It goes from 27 to 45 in 1 year. That's a big move in a large cap stock like Manulife. So it's still digesting that, and it's had a nice little punch higher this year, but not as much as you would have liked. And the third thing I would say is that what is performing in the financial sector? Banks. So that's where the money's going, and the money is just flowing there. And now what the quants do is, they'll see the estimate revisions and the momentum in that and those share prices, and they'll pile on, and that's helping to extend that move. And where would the money be coming from to fund that move? Part of it would be coming from insurance. So I think if you look at Manulife, it's performed extremely well still relative to its peers. And I don't disagree with the caller that I think it should or could be valued at $60 right now, but something will have to change to capture the imagination. It might just be as simple as credit losses start to tick up at the banks in 2026 as we start to lap some tougher comparables, and money starts to flow back from banks to insurance, and it puts another $5 to $10 on it. So that would be my explanation. I'm not sure if that's right, but as a market observer, I try to learn a little bit every day and sort of file things away as the years go by, and that would be my opinion.
Okay, let's get to our next caller. Then Mike's in Toronto with a question. Hi, Mike.
Marilla and Ryan, happy Friday. So our teenager wants us to invest his savings for him, which means something like this. Should we go with a Whitecap versus an Enbridge or both? What would you recommend?
I've never had a teenager say they want to invest their money or their savings. So,
especially into a pipeline and energy producer. I like both. We don't own Whitecap, but I can definitely see the case for it, especially now with the assets that they've been able to consolidate. It is a much more stable and powerful company now than it was a few years ago. We have a couple others that we would recommend above it on a long-term basis, and we just don't want to mess with we want the best operators and the most stable long-term. So for us, that's C&Q, and we like ARC a little bit more than Whitecap, just tilted more towards gas and condensate than light oil. But I would advise owning some of both. Enbridge is a great long-term hold. It's come off again recently. You're clipping, over 5% dividend yield. And my weighting and I'll tell you, for our clients, our weighting of pipelines, infrastructure, and utility companies is 3-to-1 over commodity producers. So we've got about 10% or 12% commodity producers in our portfolio, and we've got about 40% energy infrastructure, pipeline, renewables, utilities, gas and electric utilities type of companies. So that's our weighting, and again, diversification is always good. So for a young investor, what you want is to show them, again, want them to make some mistakes so you learn from them. You learn more from losing than you do from winning. I always say that to my hockey team that I coach. But show them what the benefit of diversification is, and show them how the different stocks move at different times. And hey, when the market's doing really well and oil prices are running, you're going to see that benefit in Whitecap. And when it's not, you're going to see the stability of Enbridge, and it helps to teach a young investor an important lesson that they can use for the rest of their life. Okay.
And Enbridge off $5 from a high, which was at the end of September. Let's go to Steve in Sarnia, Ontario. Hi, Steve.
Hi there. My question, Ryan, is trying to decide between Tourmaline and Algonquin. I know you've recommended Algonquin in the past, but what do you think of that decision? Thanks.
Similarly, I'd probably buy some of both. I think they're both pretty attractive right now. Again, we like ARC a little bit better than Tourmaline, but I won't quibble with Tourmaline. It's a great company. And Algonquin, after a long period, maybe I'm the guy that does this and I'll become known for I'm not sure this is a good thing, but we stuck with it, and now we're starting, people say, top pick on Algonquin, cleaner story going forward, management execution improving. So, and there's a long way a steady company like that can go in a short period of time once people kind of get back on board. So I like both, frankly.
Okay, dip into both is a recommendation here. We're going to take a quick break. Ryan's sticking around to take more of your questions in just a moment. Stay tuned. Welcome back. Let's go back to the phone lines. Dave is on the line. He's in North Bay with a question today. Hi, Dave.
Hi, Ryan and Marilla. My question is on Canadian Apartment REIT. What is your outlook going into 2026? And similar to Allied Properties, do you see a possible dividend cut with Cap REIT? Okay. And also, do you own the the company, and would you be buying at these levels? Thank you.
Thank you for the question. Interesting space with real estate and with rentals. Rental costs have come down. We have had a big change on the immigration policy. Both of those have affected the sector. Do you own anything in this space today?
We don't own any REITs, and typically we don't and haven't because it's been a very overvalued kind of bubbly space for a long period of time. And I'm reminded of that, if people might not know what I'm talking about, but there's a meme where it shows the Grim Reaper going in and out of rooms, and it's like the different labels of the things that he's killed and the next thing he's coming for. So first it was industrial REITs, and then it was and then it was office.
Commercial, yes.
And now it's office, and maybe retail was in there too at somewhere. And so now we've seen a big shakeout in the sector finally. And so I'm not sure on cap rate. I don't like the fundamentals for apartments. There's still a lot of condo supply that competes with apartments. There is rent control issues with governments. There is, still an over exuberance in the space. And then you mentioned the immigration reform. So, I wouldn't be buying it here. We're not, it's more interesting certainly than it was at 63. But I'm still being patient on the whole space. Allied is another company, the caller mentioned that we've looked at. So we're looking around the wreckage, but not willing to pick anything up yet.
Okay. Let's get to our next caller then. George is on the line. He's in Calgary. Hi, George.
Hi there. Yeah, my question is about Extendicare. What do you think about this company and going forward?
Okay, so
thank you.
Thank you for the question. A different kind of space, one that is growing. We know older people are in need of that assistance. Are you in this space at all?
No, well, we are. We own Savaria, which is accessibility, so more for aging at home. So we will take the other side of that trade. But this is the next one that is working. This is the REIT sector has gone from industrials working to office to apartments to now seniors housing is all the rage. And again, I think these are tough businesses. There's no limit on capacity. We are underbuilt in the demographic wave that's coming through. I mean, we can see that, but it's in the share prices is what I would say. And so just be careful. Be careful with stocks that go like that. And in a market that is actually unconstrained by supply. And there are limited public players, but there's some very well-financed private players and private equity players that are in this space as well that are adding supply. So just be careful is what I would say on these types of companies.
Okay, let's move to our next caller. Then Terry is on the line. He's in St. John's today. Hi, Terry. Terry, you there? Okay, we may have lost Terry. Let's see if we can get to Mary, who's in Ottawa with a question. Hi, Mary.
Hello.
Go ahead.
I would like to know your opinion on where Propel Holdings is going.
Okay, thank you for the question. Propel took a hit earlier in the year when there were concerns in the U.S. about some credit. What is your forward take on this space, first of all?
Yeah, so the space is definitely creaking. It's like the pipe in your house that might burst at some point. It doesn't sound good. I had a plumbing issue this morning, so maybe that's on my brain. We are far away from this space. So we talked about Dye and Durham earlier. Similarly here, you see problems that go easy. Equitable Bank's results have been pretty poor, but now overshadowed by the large acquisition they're doing, which we think is pretty good. And Propel is an even kind of smaller player in this space as well. So subprime credit, I think we have to all be very careful. I don't think we are going into the exact same 2008, 2009 scenario we saw. That was more about the securitization and the counterparty risk. But I do think we are in some sort of a credit cycle. And it's unlikely that interest rate cuts are going to save us this time because they're not coming from a high enough level. And so, and I don't think they'll be able to, we've seen how sticky the inflation numbers have been. I don't think they're going to be able to get down to a level that's going to save people either. So I think we got to be very careful with this space as well, and we would not be around.
Okay. Let's get to an email then from Bill. Bill says, I'd like Ryan's opinion of LIF, LIF, as a long-term hold for a retiree. Is this LIF 360?
No, it's the Labrador Iron Ore Fund.
Okay.
The iron ore mine that they have a royalty on. I think Rio Tinto is the operator, so they get a dividend at a Rio Tinto depending on how the operating characteristics go and the pricing. It's been a great company, actually. If you look over a long period of time, great dividend yield. They pay special dividends, so if you look at just the base dividend, you're not counting all the specials that it's paid over the lifetime, so you need to sort of go into a program and run a total return calculator on it. I do think it's a good holding for a retiree if you look at what's happening in the world now. Iron ore specifically is more commoditized than some of the other metals, so it's not going to see the kind of bumps we're seeing in rare earths or copper or gold, obviously. A totally different story in gold, but you get the picture. But pretty steady and good income, so I don't mind it. We don't own it for clients. Again, there is just the volatility in the metal space that we like energy a bit better as a stable commodity that doesn't quite have the same depths of cycles.
Okay.
But I don't have a problem with it at all.
All right, and a good 4.5 dividend for that company. Let's take a quick break. We will be back with new top picks from Ryan in just a moment. Stay tuned. Welcome back. Join us on Monday for Market Call. Teal Lind will be on the show, manager at Lind Equity Fund. He'll take your questions on North American stocks on Monday. And time now for new top picks from Ryan. We're going to start with Brookfield Infrastructure, BIP.UN on the TSX. We talked about Brookfield Renewables earlier in the show. Why do you like the infrastructure play in a top pick?
Yeah, and so again, it's important to note that is the .UN structure. It's trading at a 25% discount to the corporate shares, which are owned more by institutions and U.S. investors. So it shows the company's being valued two different ways because it's exactly the same, very, very much the same assets. The corp structure just holds the units. So I think you're getting it at a good price. Buying the units, you get a third more yield, like 33%, 3.75% yield on the corp units and almost 5% on the .UNs. So in a RSP or TFSA where you don't have to worry about the additional tax reporting that's required, to me it's a no-brainer. And then when you look at the underlying assets of the company, you've got everything you'd want. You've got toll roads, you've got exposure to data centers, you've got natural gas and natural gas infrastructure, you've got cell phone towers, you've got global diversification, you've got the ability to recycle assets and continue to source new assets and divest at good prices. So with a 5% yield that is growing at 5% a year. So to me, it's everything you'd want. And even though it's had a nice year, again, if you're able to buy the .UN structure, you've only achieved, it's not as trading as richly as the corp shares. So I think there's still more upside.
I was going to say you buy in where it is today.
Absolutely.
Okay. Let's go to your next pick then, which is Aecon Construction, ARE on the TSX. Tell me what you like about Aecon. Is it sort of build out for what's expected next year?
Well, and so again, it's had a nice. This is one we suffered through some tough times with, down to, I mean, even just this year it hit $15 again, but it was $8 or $9 a couple of years ago, and we're finally seeing things come to fruition. They just delivered Eglinton LRT and Finch LRT, not necessarily into service, but substantial completion. I think the market liked that, and you saw the stock run. And it's not often that I will recommend a stock that's breaking out to, at least it might be all-time highs, but 5 to 10-year highs, but there's just, again, when you go down the list of what this company is executing on, great nuclear franchise, signed a big MOU of nuclear in the States. They're doing some targeted M&A in the States that is helping to expand their capability there on power and transmission. They've got, again, there's going to continue to be civil work that needs to be done, bridges, transportation, fiber to the home build out, fiber build out, data center build out. So just does everything that is you would want, and it's not as valued as aggressively as the engineering and construction companies, which you saw come off on some AI fears a few weeks ago. I think there's still upside in this name as maybe that trade rebalances a bit and people start to look to, hey, what will AI not disrupt? Well, it's actually the construction. We like it quite a bit here, even at these levels. And we're maybe not buying a full position. Back under 30 would be better, but we're happy holders and adding a partial position even at these levels.
Okay. Let's get to your last top pick today, which is BCE. BCE on the TSX, parent company of this channel under the Bell Media brand. We talked a little bit about TELUS and Rogers today. Why BCE in that space?
Well, and again, I'm not a big fan of momentum trades, and I try to stay away from it. When it's in a stock I already own, I try to not have my head in the sand either. So in the past week and a half, everybody's coming out with their year-ahead look forwards. BCE top pick on, I think, 5 or 6 brokers have just upgraded it. And so the upgrades start to come through. That flows through the quants. We start to see a reversal of funds flow. Just met with management as well. Very pleased with the fundamental tack they're taking for the company. They're pretty excited about Ziply, actually. So I think that has potential for upside surprise. You're still getting about a 5% yield. So you'll notice like the 2 out of these 3 companies today, we're still getting a 5% yield. I also think that if and when markets get choppier, you're going to see money flow back to what's sort of cheap and stable, and that's BCE as well. So when some of the froth comes out of the market, this could actually be a beneficiary, and it's been trading like that recently. I bet you today it's up, would be my guess. And we're also coming through tax loss selling season, so there should be maybe some, I know I tax lossed it for a few clients, so you're going to be seeing some buying coming in January on that as well. So I think it's a pretty good level. And again, we're never on a 1-year view or a 6-month view. This is a long haul play. And from these levels, yes, it's frustrating to see it come down from 63, but it probably goes back up to 63 someday too.
Interesting. Okay, we got to leave it there. Thanks for coming in. Appreciate your time.
Appreciate being here. It's great. Always great to be here.
And have a good holiday season. We got to leave it there. Thank you for joining us today on Market Call. We'll see you back here again on Monday.